I'm Craig Popp with Accrue Wealth, and this is your third quarter 2025 market update. As we begin the final quarter of the year, investors are facing conflicting signals. The S&P 500 reached new all-time highs in the third quarter as markets continued to be supported by strong corporate earnings and enthusiasm for artificial intelligence. At the same time, the labor market has weakened considerably since the beginning of summer, raising concerns over the underlying economic and financial health of consumers. Despite this, GDP growth has been strong and inflation has largely stayed in check. Market environments like these are when the benefits of long-term investment and financial plans shine. Rather than reacting to headlines and economic reports, it's more important to hold well-constructed portfolios that can withstand market shifts. This requires understanding the underlying trends that will shape markets in the quarters ahead. Let's take a look at key market and economic drivers in the third quarter. The S&P 500, NASDAQ, and Dow Jones Industrial Average gained 7.8, 11.2, and 5.2% respectively during the third quarter, with all three reaching new record highs in September. Year to date, they have risen 13.7, 17.3, and 9.1%. The Bloomberg US Aggregate Bond Index gained 2% in the quarter and is now up 6.1% year to date. The 10-year Treasury yield ended the quarter at 4.15%, after falling as low as 4% in September. Developed market international stocks rose 4.2%, and emerging market stocks increased 10.1% in the quarter. Gold rallied to a new record level of $38.41 per ounce, representing a 16% gain during the quarter. The US dollar index fell to a low of 96.63 in September before ending at 97.78. So far this year, the dollar has declined almost 10%. The consumer price index increased 2.9% in August, while core CPI rose 3.1%. Only 22,000 net new jobs were created in August, according to the latest report by the Bureau of Labor Statistics. Since May, the average monthly pace of job gains has been only 26,800. And finally, at its September meeting, the Federal Reserve cut rates by 0.25% to a range of 4 to 4.25%. One of the most important considerations for long-term investors is the level of valuations for the overall market. Rather than simply focusing on the price of the market, valuations tell us what we're getting for that price in terms of earnings, cash flow, sales, dividends, and other corporate fundamentals. While high valuations suggest that investors are optimistic, they also imply that expectations may be too lofty in some parts of the market. This chart details the Shiller price-to-earnings ratio for the S&P 500. The current value of almost 38 times is well above the 35-year average of 27 times and is approaching levels last seen during the dot-com bubble. This measure provides a longer-term perspective than standard price-to-earnings ratios by using a 10-year history of earnings adjusted for inflation. The fact that valuations are at these levels should not be surprising given the strong rebound of the past 2 quarters. The S&P 500 has climbed 34% since April 8th, resulting in a double-digit gain for the year. Technology stocks across various sectors have led the market on the way up, just as they did on the way down. The Magnificent Seven stocks, for instance, have risen 61% since the bottom. While investors are increasingly questioning whether corporate spending on artificial intelligence will generate a positive return, the reality is that this has been a key driver of the broader market and business investment. It's important to note that valuations don't predict short-term market movements and are not market timing tools. Instead, they serve as core inputs to the asset allocation process. While broad market valuations are elevated, this is not the case across all parts of the market. For example, small caps, value stocks, and international stocks have more attractive valuations than large cap growth stocks. This can create opportunities for investors with a broader perspective and longer time horizon. The Federal Reserve cut interest rates by 0.25% in September, resuming its easing cycle after holding rates steady through much of the year. This decision reflects the Fed's attempt to balance stubborn inflation that remains above the 2% target with a weakening labor market. The rate cut was widely expected and has served as a tailwind for markets in recent weeks. There are many factors that make this cutting cycle unique. Historically, the Fed has been forced to cut rates in response to economic crises or recessions. While there are some signs of weakness today, overall growth remains healthy. So recent cuts represent something different, an attempt to normalize policy after the rapid tightening cycle that began in 2022. This is one reason the Fed is easing policy even while the economy remains in expansion and markets trade at all-time highs. Perhaps the most important factor driving the Fed's decision has been the deterioration of the job market. While the unemployment rate of 4.3% remains low by historical standards, the pace of job creation has slowed dramatically. August saw only 22,000 new payrolls added, well below the average of 123,000 from earlier in the year. Even more striking are the payroll revisions, suggesting that 911,000 fewer jobs were created over the 12 months through March than originally reported. As shown in this chart, the Bureau of Labor Statistics revises the payroll numbers each year based on more accurate data than was available at the time of each monthly report. While the numbers are still preliminary, a revision of this magnitude would represent the largest in history, showing that the job market has been weaker than originally believed. The Fed is cutting rates because, according to their latest statement, it judges that downside risks to employment have risen. For investors, rate cuts typically provide support for both stocks and bonds if the economy remains strong. After significant volatility driven by tariffs and taxes earlier this year, measures of economic policy uncertainty have improved. The VIX index of stock market volatility is hovering around 16, below the long-run average of 18, while the MOVE index of bond market volatility has declined to 78, below its average of 87. As many long-term investors know, periods of market calm can change quickly. The last several years have experienced many episodes of heightened volatility due to inflation, trade wars, Washington policy, the Fed, recession fears, geopolitical risk, and much, much more. The current government shutdown is but the latest event that could rattle markets in the short run, even if the long-run effects are limited. It would be fair to say the outcome of tariff policies and the impact on inflation still remain uncertain. For investors, this uncertainty may feel uncomfortable, but it's also what drives long-term portfolio outcomes. The last several years also highlight the difference between what investors feared and how markets actually performed. Rather than viewing uncertainty as something to avoid, successful long-term investors recognize it as a feature of markets that creates the opportunity to position portfolios for the years ahead. As the final quarter of the year begins, markets are near all-time highs amid conflicting economic signals. This environment underscores the importance of maintaining an appropriate asset allocation and staying focused on your financial goals. Thank you for your trust in us. Contact me if you have any questions.